Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Markify. I'm your co-host, Joel Elconin, and I have Nate Tobik on the line. He's an investor and founder of CompleteBankData.com. Nate, how you doing this morning?
Good, doing well. Thanks for having me on, Joel.
Okay, so here we are in the midst of earnings season, and I think all in all, I think investors are pretty satisfied. We've had some ups and downs with a few stocks, but bank stocks have been holding in there. What's your assessment so far of earnings for the bank stocks?
Right, so banks have done fairly well. They continue on the same trend that they've been on for the past couple of years, which is earnings have been improving. Loan demand, we've seen loan demand coming back, which is phenomenal, especially for some smaller banks. So there's been a lot of banks that have essentially been sitting on the sidelines saying, we're waiting for rates to go up, we're waiting for the economy to recover, and I think they're finally going to get their chance to make some new loans and to start to grow. And the more aggressive banks have been growing and taking advantage of this environment the whole time, taking up market share. And so savvy banks have been doing well. We've seen Bank of America, Wells Fargo, they both came out with earnings that were expected. And then incidentally, if you look at a chart of the KBW Bank Index, you could see the index traded down to about 66 right before earnings came out, and then it's been almost a straight line up to 72 since then. So the market has been happy with what's been going on, and I think that bodes well for investors.
Okay, is there any stocks that it may be still some time to get in on any regional banks that you're looking at?
Right. I definitely, and I like the regional banks over the larger banks. A lot of people, when they think of banks, they're thinking the big ones, J.P. Morgan, Wells Fargo. But I think the opportunity is really in the regional banks. And so a lot of larger banks are limited in how they can grow. So there's a federal rule on how much deposit market share a bank can have in a specific market. And so if you look at banks like PNC, or Fifth Third Bank. These are banks that are still growing. They're taking advantage of the market, and they are bumping up against those rules. So they could grow by acquisition in markets where they don't have a significant presence, and that's something that you're not going to see Bank of America taking off a meaningful acquisition at any point soon. Whereas, I wouldn't be surprised to see Fifth Third or PNC acquiring some smaller tuck-in banks at some point.
And what did you say the restrictions were to growth for some of the bigger banks?
Right. So in each the Federal Reserve and FDIC look at each metropolitan market area, and they have this concentration index that they use, and so a bank can't have more than a specific score per area. So you're never going to go to a city and see one bank dominating the deposit market share or that banking market, because that won't be allowed. So there'll be this is why if you see two banks that merge across the street from each other, or a good example where I live here is when PNC purchased National City, the regulators forced they forced PNC to sell off a number of the new branches that they acquired, which they sold them to First Niagara. And this was so that PNC wouldn't be too concentrated in certain markets.
What about stress tests? You really, that used to be a pretty big thing that the market focused on, and you really, that's really not a big deal. And as the liquidity levels of these banks are returned to normal, and it's really not a factor anymore.
Yes. So when I think the way stress tests work is when markets are going up, no one's worried about them. When markets are going down, so
And we did have Nate Tobik on the line here, and Nate's from CompleteBankData.com, and he was giving us his assessment here of the banking industry. We are trying to get Nate back here. In the meantime, here we are 3 minutes before the open. If there are any issues that you're looking at trading today, I'd like to get a look at. I believe Colts Lug put one in here a little bit ago, and I think, if I'm not wrong, I think it is GILD, Colts Luck. Colts did look good last night, so you were lucky. But let me know if you think that if that's not the issue you wanted to cover. GLID made a new all-time high on Friday. Let's take a look at Gilead Sciences. Sure did made a new all-time high on Friday at 116.83. All-time closing high though is 114.22. You had that in Thursday's session. Trading a little bit down here in the pre-market, but we are still
Are
firm.
you Nate Tobik? Please leave a message. Thank you.
108.81 was the low in yesterday's session, and that coincide not really another low at 108. So, looking to protect some profits here in GILD. Take a look at the 108 level. Let's see how Baba's trading here. Shortly before the open, we got 1 minute before the open here. Baba delivered some decent earnings to the street, bouncing around quite a bit in the pre-market, trying to maintain the $100 level. Let's just keep an eye on Baba. Baba just made a pre-market low. This was in the 8 o'clock hour in 99.22. It has been migrating towards that level. We will be keeping an eye on that here early in the session because yesterday's low was also at 99.05. So 99, a key level in Baba. The street did not like the earnings at all from Priceline. Well, the earnings were good, but not looking good
Hey,
on.
Joel, back on
Hello,
here.
hey Nate, how you doing there? The Gremlins are getting on our show. We were
Good.
talking about stress tests, and you made a good
Yeah,
point that when the market's going down, everyone cares about it. When we're going up, no one cares. So I guess until we have another financial crisis, people are not going to worry about it. I want to ask you about a couple individual issues here.
sure.
Goldman Sachs really showing some life here. What is that something you've been? Does that fall into your bank? I mean, they're an investment bank. Where do you put Goldman Sachs?
Yeah, so Goldman Sachs, I casually follow them, and their stock has done pretty much the same thing as every other bank since the 15th, and it's had a little bit of a rally. And that what makes Goldman different, and same with Morgan Stanley, is even though they're regulated as banks, they really aren't in the business of banking. So they take in some deposits, some wholesale deposits, but by and large, and Goldman Sachs their results are a function of, I guess, the market overall. So investment banking and the health of the economy. So we start to see mergers and acquisitions tick up. We see Goldman's stock tick up because they're the first number everyone's given a call to.
Okay, and that stock has made a nice move here. Taking a look at Goldman Sachs here, and actually trading at levels I believe that you haven't seen since 2010. Or let's see if we can go to the monthlies and take a look. So Goldman kind of late to join the rally, but it is there just on the daily chart. Goldman Sachs, I believe we closed over the 190 level yesterday, firmly over it. Closed at 190.83. Haven't quite got to that level in today's trading. 190.68 has been the high, but 190.83 has been the recent high of the move. Any bank stocks that you're avoiding, Nate, just for one reason or another?
Yeah, so I wouldn't say avoiding, but I was running through some of our models yesterday, and the one thing I noticed is most banks are trading right around fair value. And so when you have banks trading at fair value, what you're really counting on with an investment is that you're making a bet on the bank's management. So if you're going to buy at fair value, that's okay. You probably want to buy something that has a lot of growth in it and it's not overvalued. But with everything moving up, what we've seen is a lot of banks trading right around a fair value that maybe don't have the business fundamentals to support a value that they're trading at. And the markets, in terms of the bank index, is pretty reasonable, about 1.3 times book value, and about 16 times earnings is where things are at. And so that's reasonable for most banks. Some of the banks with a lot lower quality earnings are they're trading up to that level as well. And so I'd maybe be cautious about some of those. But the flip side is, I think that we could see this mergers and acquisitions market. A lot of the smaller banks, they're getting the phone call to finally sell out, and so maybe a bank with a little lower quality earnings that's trading at a discount to their assets is going to see a big boost. And there's been a number of deals recently that have gone for almost 100% more than the last trade, because they're being purchased at an acquirer's multiple.
Any particular regions you think would be more susceptible to the merger and acquisitions?
So one area I've heard off and on for the past few years are banks in Indiana, and I don't know. That state's a little overbanked. There aren't that many. Most of the banks that are there that are traded are smaller banks, and so there's a lot of small private banks that are going out there. Up the East Coast, there's a number of banks as well. If you look at the older markets, I guess you could say, so the East Coast, the Midwest, that's where you're going to have a lot of legacy banks, and that's where you're going to have a lot of areas that are overbanked, whereas a newer area that's developed recently is more of a situation that's balanced, I guess you could say.
Okay, all right. Any only overall thoughts on the market here? I mean, we had washed out in the middle of October, rallied off the lows, and then paused and then blasted off again. Any general thoughts on the market?
Yeah, well, not as much on the market. I just have one general thought on rates and how rates pertain to banking. And so, I think with quantitative easing finally over, I've heard a lot of chatter that this is the moment we're waiting for. And so we've seen the economy picking up, loan demand picking up. And so I think we're going to be entering, maybe you could call it a honeymoon period for some banks, where they're finally going to be able to make a little bit more on loans, and we have the demand there. I know the counterpoint is that if rates are up, then people aren't going to be borrowing. And I'm not sure how true that is, because the 30-year mortgage moved up from, at the end of 2012, we're at 3.4%, and now it's about 4.2%. And loan demand now compared to 2012 is night and day. So people are borrowing almost 1% higher, because at these levels, 4%, 5%, even 6%, that's not a rate that's going to hold people back from buying a house.
Okay, Nate. Well, thanks a lot for coming on. We appreciate you coming on Benzinga's Pre-Market Prep, brought to you by MarketFi, and we hope to speak to you again soon.
All right. Thanks again for having me.